Hello, and welcome to Do It for Grantley, a podcast brought to you by Fortress Fund Managers, where we speak with women and men in Barbados about their Grantleys and other money matters. I'm Kim Howard, Marketing Manager at Fortress, and my co-host is Omar Kennedy.
Hello, listeners.
An entrepreneur, author, and former financial manager. In today's episode, Active Income and Passive Income, we'll speak with avid investor Antonio Arthur. Antonio works as an IT manager in the financial services industry and also lectures part-time at the University of the West Indies Cave Hill campus. Together, we'll discuss the differences between active income and passive income and their roles in bringing us financial success. We truly appreciate you taking the time to listen to us. So let's get to it.
Financial security doesn't grow on trees. It's built brick by brick with smart investments and a strong partner. To retirement, education, and whatever your future may hold, we say bring it on. At Fortress Fund Managers, we're not afraid of the hard work, long hours, or steady saving, just like you aren't. We know better than anyone that you can't just hope for good luck. Call Fortress Fund Managers on 435-7777 to build your personal fortress.
Your future, our business. Fortress.
Good morning, everyone. Welcome to Do It for Grantley. My name is Kim Howard.
I'm Omar Kennedy.
And today we are pleased to have Antonio Arthur with us today in studio. Hi, Antonio.
Hey, good morning. Very happy to be here.
Thank you. Antonio is an IT professional specializing in the finance sector, essentially?
That's correct.
Okay. And so we wanted to have him here to discuss our topic for episode 13, which is passive income and active income. And as you may recall, Do It for Grantley is a podcast brought to you by Fortress Fund Managers. We are a mutual fund company operating in Barbados since 1996, and we provide mutual fund investments for per individual as well as organizational investors who want to grow their wealth. We already have another 12 episodes available. You can listen to them all on our website at fortressfund.com. And they range in topics from saving versus investing, retirement planning, productive investment, credit management, and investing in your health.
That was my favorite one, investing in your health. We had a lot of fun on that.
You had a lot of fun, but what action did you actively take?
Let's move on.
Well, let's move on to tell everyone exactly what a mutual fund is so that we're all in the same space.
Okay, a mutual fund is an investment product which pulls together money from investors, which would be you, and it puts them all together in one pot, in one pool. Then the fund manager, Fortress, would take the monies and invest them all over the world for you. It works on the principle of diversification, not putting all of your eggs in one basket. So instead of you investing by yourself and being able to only invest in maybe 1, 2, or 3 companies, what you can do is invest in a Fortress mutual fund, and through the investing protocols, the money management and the financial management that they do for you, you invest in hundreds, sometimes thousands of different equities and countries all over the world. This way, you get to maximize your returns and minimize any potential losses.
Antonio, you've been investing for quite some time. Tell us a little bit about the difference between passive income and active income.
Right. I don't think active income really needs any explanation.
No, tell us.
That's what most of us. That's what most of us are familiar with: a job, a 9 to 5, or more or less self-employment, providing some service that's in demand. Passive income, on the other hand, is when you're relying on an investment to provide income without you doing much work or having to, expend any resources.
So, all right, let me pull out that a little bit more because some of our listeners may not be familiar and may still be a little bit unsure. Active income would be when you make a decision to go and, invest in the stock exchange. Is that active?
No, that would be
right.
Passive income.
That would be passive.
Okay, cool. So we're going to talk a little bit about that and get some clear examples a little further on.
So let me just make sure that I'm understanding this. So you're saying active income is something that we work on every day. We work hard at it, and at the end of every period, we get a check or some cash for the effort we inputted into that particular project. Whereas passive is like fire and forget. What do we call it, Kim?
Set it and forget it.
Set it and forget it, where you would put some money down or put some expertise down, and then it starts to generate income for you long after you finish working with the project.
What I would say is that perhaps passive income is a bit of a misnomer in the sense that a lot of the work is done up front. And then later on, you reap the rewards.
Okay.
But you're still required to put in quite a bit of work initially in terms of research and, actually trying to determine what investments to make.
And so tell us then a little bit about, well, from your own perspective, is it possible to have financial success solely from active income or passive income?
What I like to say is that anybody that asks me for advice on investing, I like them to make sure they have at least 3 to 6 months of living expenses saved in case they have an emergency. And this should be somewhere like a credit union or somewhere that is where the money is easily accessible. Now, when you start to invest, then you take a small portion of your income and you put that into something, some into a safe investment and some into riskier investments.
As Kim was alluding to just now, do you think persons can actually become wealthy from active or passive income? For example, should you have active income first before you become a passive investor? Can you just jump in and be a passive investor? Can someone just become rich from just starting from either end of the spectrum? Or should you do both?
Well, I've always been of the opinion that it's very difficult to become wealthy solely as a result of your own labor. That's why investing allows you to leverage the labor of other individuals.
Is there, I'm thinking about things that I've heard in the past. Is there possible to generate passive income without being an actual investor?
Well, as far as passive income is concerned, there are a lot of different ways to earn passive income. There's rental income if you're lucky enough to have an additional property. There's the stock market and there are dividends that are paid. We don't pay any capital gains tax in Barbados. So if you see an increase in the value of the shares that you have, that's all.
That's yours.
That's profit.
Right.
Agreed. And there are also things like persons who may be authors or people who may be music producers or whatever have you. They can produce a piece of intellectual property, and then, as time goes on, they can also receive passive income for their efforts when they produce the property.
Yeah, and I would like to spend a little bit more time on the whole concept of the stock market because I think it's very important in terms of Barbados' recovery. The challenge that we have is that a lot of the investing is done right now by accredited investors and institutions as opposed to retail investors. So we need to encourage the average person to own assets.
And when you say retail investor, you're
That's
talking
like you or me.
Yes, that's
yeah.
Good.
Okay. So you would find then that the big companies who have shares in the institutions on the stock exchange, they're doing the majority of the trading that's going on there, and so the average person is not seeing any benefit. Is that what you're saying?
Correct. I think it's also a myth that the average Barbadian doesn't want to invest, because the number of people that ask me on a regular basis, I have some extra money, just got paid my bonus. What do I invest it in? And it's just the barriers to entry are so severe that the average person, especially this generation, they have expectations in terms of how, they invest. And the current facilities don't allow for that.
Or is it perceived? Sorry, I was going to say, or is it perceived barriers to entry? Because, you can invest in a mutual fund with Fortress for as little as $100 so to start. So that is a perception that a lot of people have, and I think you're quite right there about that, because I've encountered it over the years.
That's correct. But I was specifically speaking about the stock market, the stock exchange, where you have to go through a broker. And I would really like to see us get to the stage where the stock market and the brokers become more innovative and they facilitate investment from the retail investor. Now, that's going to involve some kind of online funding, online trading, and online facilitation of KYC, because the average person doesn't really want to walk in.
What is KYC again?
Know your customer.
Okay.
Very important in terms of anti-money laundering and whatnot.
Perfect.
Right. And that's where people have to fill out all those forms and provide all that background information when they go into an institution to set up an account. Is that correct?
That's correct.
Right.
So what actually prompted you to become an investor?
Well, as I mentioned earlier, working a 9 to 5, you will make enough money to survive. But if you want to be independently wealthy, or at least some level of financial freedom, achieve some level of financial freedom, you really need to look at high risk, high reward investments.
That sounds scary for a lot of people. Tell me a little bit more about this concept of financial freedom.
Well, financial freedom to me really represents the ability to earn enough income from your passive investments to satisfy the lifestyle that you're accustomed to with your regular 9 to 5. I've been actively investing, I would say, at least for the last 4 years.
Okay.
The vast majority of my investments are high risk, high reward. I maintain a savings to an emergency fund, and then the vast majority of what's left over goes into aggressive investing.
And this is what we've gone back to in a lot of our previous podcasts as well. Antonio is a relatively young man. So he falls into the category where we can say that you can invest in riskier investments. And as you get older, persons tend to go towards less risky investments because you have a closer time to retirement or a closer time to your financial goals. So if there's any up or down swing in the market, you are not negatively affected by any crisis which is going on.
And tell us a little bit too, Antonio, about your investment journey. You said you've been doing it mostly for about the last 4 years. Tell us, have you encountered any particular obstacles or surprises, things that you didn't expect?
Well, I think the biggest challenge is dealing with the psychological challenges of investing.
Tell us.
Because you have to be very careful, especially when it comes to high risk investments, not to be over invested, because then you won't make logical, unemotional decisions.
Okay, let's break that down a little bit. When you say over invested, what do you mean?
You need to make sure that the money you've invested, when it comes to high risk investments, is money that you can afford to lose.
Right. So you can deal with losing it. It's not money that you need per se.
That's correct.
Good.
And there's another thing, when we start off investing, we often start off as intellectual investors. After the market starts to fluctuate, I find we become a bit more emotional. So what happens sometimes, you may say, well, I would like to invest 10% in each of these things. But then when you realize one thing is doing exceptionally well, you may say, okay, because it's doing so well, let me go and put all of my money in this. And you break your investing strategy, which you had crafted before you started, and it becomes emotional investing then. And then if something bad happens, you can be negatively impacted.
Let me just add to that in the sense that when you're dealing with high risk investments and you actually see the rewards, you may at some stage need to rebalance your portfolio, because you probably would only like to invest, maybe 5%. You probably only want 5% of your portfolio in high risk investments. But when you see a large change in the price of the shares, you end up with maybe 50% of your investment being in a high risk investment.
And you said, so the psychology of it was the thing that you found most challenging. And I think we've touched on that before, that and the concept of the psychology and the emotional investing, which Omar talked about as well in one of our previous episodes. So how have you been able to surmount that challenge of having the challenges psychologically?
Well, I've done a lot of reading.
Okay.
There's a book called The Education of a Value Investor, which I think is invaluable.
Who's that by? Do you remember? Don't worry about it. It's okay. I'll put it in the show notes, everybody.
Okay, no problem. No problem.
The Intelligent Investor is also another one that I think Peter had spoken about, on a previous episode, about the whole thing of value investing.
Right.
And so you said you did a lot of reading, and that was one of the things that helped. Anything else?
A lot of research.
Okay.
The biggest challenge I have with people that ask me what to invest in is that they're generally unwilling to do any research. And I always say, if you're investing in a company, you should believe in the vision of the founder. That way, even if you lose money, you can say that, I believed in what this person was trying to accomplish.
And because, they may have lost money this week, but it doesn't mean that 2 years from now they won't be making
That's correct.
Twice as much.
Agreed. Even when it comes to investing in mutual funds locally, you have to do your research as well. You look at the previous returns, and even if you are going through a negative cycle, you must look even further than that and realize, well, this company's been doing exceptionally well for the long run. You look at the philosophy of the persons who are the board of directors. You look and see what is the philosophy for investing, high risk, low risk. Are they environmental investors? Because there's a very large group of persons who only invest in persons who are environmentally savvy. So you're not investing in companies which do chemicals or create guns or tobacco or liquor. The research is very, very important, as Antonio said.
But I think you're right. I think a lot of people want somebody to hand them a off-the-shelf solution. They often don't necessarily want to, or sometimes I think they feel they're not capable of doing the level of research that would make them feel confident and comfortable, which in some ways is why a mutual fund helps, because we do that research, and you then don't necessarily need to be worried about your level of competence. The hardest thing you need to do is to make sure that you check on us and make sure that what we're doing is what we're supposed to be doing. And I think
Or in line with what you want.
or what you believe in.
Yes.
Exactly. So yeah. But I do think you're right there on that, Antonio. And any other challenges that you found that you had to surmount aside from the psychological tug of war that you encountered?
The other major challenge is isolating yourself from the noise, because we tend to think that we have more control over our thoughts than we do.
Right.
Our environment really impacts us a lot more than we appreciate. So whatever environment you're in that is maybe negatively affecting your decisions, your choices, you need to find a way to isolate yourself and find yourself in an environment that is conducive to what you're trying to accomplish.
What does that look like for you?
Well, for me, I had to turn down some of the noise in my world, that it meant maybe leaving a few WhatsApp groups and, things like that where the noise was kind of overwhelming my thought processes.
All right. Okay. Don't believe the hype.
Yeah. Stay off of social media.
Social media and also news. Like people talk about that too, because I sometimes will have people say, "Oh, I saw on the news that such and such happened in whichever country, and the stock market responded. Is my investment with y'all safe?" Like we're going to continue
But
doing the
that's-
thing that we've planned to do and we researched to do, and so yes, your investment is going to continue along the same path that it's been continuing on.
Correct. And that's where research and a shared belief in the vision of the entrepreneur that you're investing in comes in, because you don't respond to the day-to-day swings in the market.
And you must understand this comes down to emotional investing as well. Use multiple news sources. If you only look at one set of news sources, because the media companies have their own agendas.
Yes.
So, and depending on which government is in, for example, the media will act to suit. And this is internationally now. So you must understand that, you have to have a wide variety of resources to make the most educated decisions.
Yeah, and our news cycle tends to be U.S. dominant here. And there's a lot more going on in the world of investing far beyond the United States.
Absolutely.
So, with our investments, you get access to some of those markets in South America, Africa, Asia, wherever, Europe. And yeah, so people, I think, tend to panic a lot because of what they're seeing coming out of the U.S. news cycles.
And it's very
more so.
sensational as well.
Of course.
I think this topic is very relevant now, because with the removal of the minimum rate on savings deposits, a lot of people have been forced to really think about how can I actually make a return on my investment. And I always supported that move because, in my opinion, I believe in productive use of capital, and leaving money just there, maybe accumulating 2%, 3% interest. That's fine if that is your safe investment, but you also need to encourage the entrepreneurs and fund the entrepreneurs. And working in a financial institution, I find the challenge that I have is that entrepreneurs sometimes expect financial institutions that are conservative to fill the void that is left by the absence of a junior stock market.
Yes, and actually Simon touched on that a bit, didn't he, when he was talking
he did.
about, productive investment, and persons who need the investment are not able to get it from the financial institutions because they are a bit more conservative, whereas the entrepreneurs tend not to be. And there is no active way. I mean, we're now getting someplace where we're getting a lot more venture capitalists and angel investors and whatnot. But, it's very difficult for an investor, for an entrepreneur, to get that capital.
But what I would say is that the relaunch of the junior stock market is just around the corner. So, and I do believe that the shareholders, the new shareholders in the local stock market, I believe that they have a very progressive vision.
Okay.
And we should very shortly see an increase in trading volume.
That would be good news.
That'll be wonderful, actually.
The whole thing of the minimum savings rate has been something that has plagued me. My concern about it, rather, has plagued me for some time, because the removal of the minimum savings rate. Because to this day, there are people, when I ask them, well, how much are you getting at your bank? They have no idea what I'm talking about. They didn't know, because I did a presentation shortly before the minimum savings rate was removed. And I remember asking the room of people, How much interest do you get? They had no idea. I'm like, I can't remember. I think the date it was removed was maybe April or May. And I said, well, what's happening on this date? No idea. No concept. And my concern is that, yes, some people are beginning to think of what else they can do with their money. But I think a lot of us are still here in Barbados waiting for somebody to tell us and not necessarily moving to a place where they can identify, right, I have this 9 months worth of money saved to secure me for if any emergency happens, and the rest of it, I want to do this. Or they want to get a rich quick solution. So I'll get a call saying, hey, so what can Fortress offer me that, I can get like something next year? Sorry, did you call the wrong place?
Yeah, I am very wary of, there are a lot of scams out there. MLM schemes that people need to be very, very cautious with.
What is that again? What's LMM? What LMM? MLM.
Not the candy.
Yes.
MLM.
What is that?
What does it mean?
The multi-level marketing schemes is what it is?
That's correct. The multi-level marketing schemes.
But people like them because they sound good and they see pictures of people online doing all these fantastic things. And it scares me, to be honest, because people complain about some of the failures that we've had in the industry over the years. And I think, have you learned nothing?
Well, the thing with the pyramid scheme is that there's always somebody at the top that does well.
Of course.
And the vast majority of people at the bottom, they lose a lot of money.
Agreed. And by the time these things reach to Barbados, they're 200 and 300 layers deep. So I often wonder, why do you do this to yourself? So when you're talking to a room of 600 people about these pyramid schemes, and you say, each of you go out and talk to 300 people, and you're going to see this amount, and then you're like, okay, 600 people talking to 300 people, it's not really computing right here for a country this size, So yes, I do get it. We need to have persons who want to invest speak to somebody who is savvy about the investing markets, who understand risk versus return, who understands that the money that you pay in is not to pay the person who came before you, but to actually make a return for yourself. And that's where your passive income comes from, not from someone coming in after you.
Indeed. So can you give us a couple more examples? We've kind of touched on it a little bit about the different types of passive investment vehicles that people can be engaged in. I mean, the only thing I can think of is something I heard about the other day on a news story where this teacher had developed a series of writing materials that were used as templates for other teachers. So it was hosted on this website. And so basically she wrote up these scripts and other teachers could use them for their lessons. And she did that like 2 years ago. And it's not like a giant sum of money, but she gets money coming in every month, every time somebody downloads it.
That goes back to something that I always say when people ask me about investing. What is your circle of competence?
Okay.
What is your area of expertise? You need to go back and figure out what is it that I understand better than everybody else. And that is going to guide you in terms of what you invest in.
Agreed. So for the average investor, I used to do a lot of presentations back in the day, and I would be nervous every time. And I've been doing these presentations for close to over a decade. And then one person says to me, Omar, why are you still nervous about doing these things? You know that when you go to do your presentation, everyone's coming to listen to you. And it's because you are the expert. So when you're the expert in a particular industry, you build your product around it. Persons will come to you because you are the best person and they trust you. And that is the reason why you get passive income. You build your brand, whether it be in mutual funds, whether it be in your company, which you've put on the stock market, whether you've written a book, whether you've, put out some music for Crop Over. They come, they listen to you, they give you their rep, and then that's where your passive income comes from.
So mutual funds, of course, is a means of passive income.
Oh, for sure.
And it's, I guess, is it possible to achieve financial freedom?
I think it is, but I think it takes a while. It's nothing short term. If you are going ultra risky, you must understand the reward will potentially be there, but the risk is also there. But you make money faster. What do you think, Antonio?
Well, in terms of passive income, I think I may be going back a bit. But I think one critical one that we may have missed is when you look at the pension plan that your company provides. I always tell people, make sure that you contribute the maximum amount that your company is going to match. And that is a perfect example of passive income also.
Because you're not doing anything. Providing that your company is a company that is matching.
Correct.
Because it's like they're putting money in that you have to do nothing for, apart from just putting any contribution that you can.
And it really boggles my mind when people say, well, we have that pension plan available, but I'm not interested. I don't understand it.
That's a whole other discussion that we probably couldn't get into today. But yes, and I think it takes a certain level of maturity and understanding to come to that awareness as well.
Yeah, but on the same topic of pension plans, this generation in particular, I'm very concerned about, because the average person in this generation, they don't work for a company for 30, 40 years. They may work for 5 years, maybe 7 years if they're lucky. And then when you leave, you may have the opportunity to cash out your pension plan.
And a lot of them do.
And precisely. So where does that leave you at retirement age? Because emergencies do pop up, and it's very difficult to be disciplined when that money is accessible.
And to add on that, there's a vesting period for your pension as well, where if you stay with your company for, say, less than 3 years and you leave, you don't get the portion that your employer put in for you. You need to take your own portion. So a lot of persons may end up hamstringing themselves by losing out a potential large sum of money which can go towards their future. And we know through the power of compounding that the longer you invest, the more potential money you can have at the end. So if you're leaving a company every 2 or 3 years before you could become vested and take your employer's portion of your pension, then you could be effectively cutting your pension in half, more than half, by the time compounding takes effect. Because maybe you might only get a quarter or a fifth of what you've initially gotten.
And my other concern is that there are really no defined benefit pension plans available anymore.
No, that's gone with the way of the
DC, defined
Yeah,
contribution.
gone the way of the dodo, I think.
Which is very worrying, because the average person, if you ask them how much money are you going to receive every month when you retire, they don't have a clue.
I have no idea. But also, I think that's where the opportunity exists for people to select a registered retirement savings plan. If you know, for example, that you're an entrepreneur where you're not necessarily being employed by somebody who has a pension plan, or you're somebody who, like you said, you don't stay in a role for 30 years or 10 years or even 10 years, 2 years you're gone. And there's nothing wrong with that. But just know that you need to pay yourself forward, because the time will come when you're not going to be able to do what you've been doing, or you may not want to even do what you've been doing.
Well, I guess there is nothing wrong with it, but I think it's creating a potential crisis where 30 years down the road, the average person, I don't know if they will even be able to retire. And that isn't taking into account the situation with the NIS.
Right. Well, we've hit on quite a few marks today. And I just wanted to just wrap up by saying, give us quickly what are the pros and the cons of active income versus passive income.
Well, active income is, for most people, unless you are lucky enough to fall into a fortune, is a necessary evil in order for you to actually attain enough money to invest. You need to have enough money put down that if you have an issue or an emergency, you have funds that you can rely on.
Right. And so the pro for passive income or active income? Any pros? Any particular cons? Any cons? Let's go with cons.
For passive income or active income?
Either one.
Either one.
Well, active income, as I said, there's a limit to how much work you can do.
Right.
And that, just to a large extent for the average employee, that limits the amount of revenue they can earn.
It can only be one CEO, I guess, making the big dollars.
All right. Well, thank you so much, Antonio, for sharing some of your thoughts and insight with us. It's been very enlightening. You left us, I think, with a ton of questions. So
Next season.
Yeah, I know. So hopefully we'll get to unpack some more of that in another episode, some way down the road. Thanks very much. And you've been listening to Do It for Grantley. I'm Kim Howard.
I'm Omar Kennedy.
Thank you. Bye-bye.
Laters.
Do It for Grantley is a production of Fortress Funds Managers. You can listen to and download all our episodes in all the good places podcasts are available, including SoundCloud, Google and Apple Podcast, TuneIn, and more. Or on our website, fortressfund.com. That's fortressfund.com. Remember to let us know what you think, so email us at info@fortressfunds.com or message us on Facebook, at Instagram @FortressFundManagers. We hope that you've enjoyed listening to this, our second season of Do It for Grantley. Make sure to subscribe on your favorite podcast app so you can know when the next season begins. Until next time, I'm Kim Howard.
And I'm Omar Kennedy.
Thanks for listening.